Mean reversion is one of the phenomena in the stock market that has been thoroughly studied and has been present in the stock markets for decades. Mean reversion is my favorite way to trade the stock markets. I predominantly just trade mean reversion these days using systematic or algorithmic trading strategies. In today's video, I'm going to cover a few different mean reversion setups, and what I'm going to do, I'm going to write them in the form of a code and test them all on daily charts of SPY. SPY is an ETF that tracks the S&P 500s, and what I'm going to do, I'm going to compare different mean reversion setups in the SPY and compare their results. And then in one of my following videos, what I'm going to do, I'm going to take a couple of these entry setups that we will go over today and build an actual mean reversion strategy on a portfolio of stocks. So not just the SPY, but all stocks that belong to Russell 2000 or Russell 3000 US indices. So if you don't know what mean reversion is, it's very, very simple. The markets don't just go up or down in a form of a straight line, but on the way up or on the way down, they tend to kind of move in waves or in mean revertive movements, such as here, 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 here. And the point of mean reversion strategies is to try to pinpoint these local bottoms and lows and trade them. So a typical mean reversion strategy would be looking to buy on this local low here, then it would be looking to buy on this low here. So mean reversion strategy aims to trade these smaller, less significant rotations or waves in the market. So I've got 10 different mean reversion entries setups on the screen. Please bear in mind that all of these are long only setups, so it's only to buy the SPY. Typically to short the SPY is very, very difficult. There are some strategies that can do it, but it's much more difficult to do so because, as you know, the stock market is biased to go up by design. Number one is RSI indicator. RSI is a very, very popular indicator in systematic trading, in algorithmic trading. If you've been interested in systematic or algorithmic trading for a while, you definitely came across RSI, specifically with period of 2, which is again very, very popular on daily time frames. So the number one setup is that we buy the SPY when the RSI 2 is below its level of 5. That would basically suggest that the SPY is oversold and that the mean revertive movement to the upside is very, very likely to happen. Number two is a slightly different take on this. So again, we're using the RSI, but we're not just looking at one particular reading. We are looking at the cumulative reading of RSI over the past 2 days. Okay, across these 2 days, we want the RSI reading to be below 20. So let me just visualize this very quickly. So I've got the same chart that I had on my screen before, but now it's a little bit zoomed in. So it's still the SPY. And below the price chart, I've got the indicator RSI with a period of 2, visualized in the form of a turquoise line. So the number one rule was to basically buy when the RSI 2 gets below 5. We can see that this mean reversion trigger would buy, for example, on this day, on these days as well, 3 different days in a row, on this day as well. But what if we use the cumulative RSI of past 2 days instead? So slightly different approach. So what I have on the screen now is the cumulative 2-day RSI with period of 2. So we can see that the plot below my price chart changed a little bit. And what we want to see is that we want the cumulative RSI to be below 20. Number 3 is that the market creates a lower low 3 days in a row. Okay, so if I just go back to my chart, still have the RSI there, but it's quite irrelevant at the moment. But for example, here we can see lower low, then another lower low, and then on the 3rd day, 3 days in a row, we would buy the market. Actually, it would be before that because that condition would be satisfied on this day, actually. But you get the idea. The number 4 entry trigger I've got is the lower close 3 days in a row. So that's using the exactly the same logic as the lows, but it's looking at the closes. Now the rationale behind these two setups is that we want to be buying the market, buying the SPY against a shorter term weakness, because the market has been going down 3 days in a row, expressed as either lower lows or lower closes. It's likely that now it's going to mean revert and will go up. A similar logic is the number 5 that I've got on my list here, which is that the current day's close is lower than the lowest low of the past 5 days. So that's very similar to the number 3 and 4. Again, we are looking to buy weakness in the market, and we speculate that the market will mean revert to the upside. Number 6 is that market closes 1% below previous day's close. Okay, so the rate of change of the closing price is minus 1%. And at the same time, the ATR, which is an indicator that measures the volatility in the market, the shorter term, or the ATR 5, is greater than ATR 10. Number 7 is that market closes 1% below previous day's close, so identical to number 6, but we want to see ATR 5 being lower than ATR 10. So basically what we speculate on here is that market goes down by 1%, so for example that would have happened on this day, but at the same time we don't want the volatility in the market to spike. And when the volatility in the stock market spikes, it typically signals something bad happening in the market, so that may result in the market carrying, going lower and lower. So we want to avoid that by having that additional ATR rule. Going back to my list, I have number 8, which is that the closing price of the SPY stretches below exponential moving average with period of 5, more than half of the ATR 5. So this is typically called an EMA stretch kind of setup. So let me visualize that as well to give you a better understanding of what this is. I've got the exponential moving average with a period of 5 applied on my chart here. And then below the chart, I've got ATR with a period of 5. Now ATR, like I said, is a commonly used indicator that measures volatility of the market, and I work with ATR in my mean reversion strategies. For me personally, this is one of the most useful indicators that are out there. And basically what we want to do with this mean reversion trigger is that we want to time the entry, so buy the SPY, when its closing price basically stretches below the EMA by half of the ATR's reading. And the logic behind this rule is that we want to buy the market when it's most likely to mean revert back. And we measure that by ATR. So again, if I just visualize that below my chart, for example, on this day here, I can see that my entry trigger is equal to 1. That means that this rule that I just described was satisfied, and this system would buy the market there. Obviously, that's not a very good example since the market kept falling since. However, we can't just be looking at the couple of trades here. We need to obviously test them on a sufficiently long history. Now, very similar rule to the one that I just described is rule number 9, which is that closing price stretches 1% below the exponential moving average. So I'm not using the ATR, but I'm just working with a fixed percentage, which is 1%. And then also rule number 10 is that the exponential moving average decreases by 0.5% compared to previous day's exponential moving average. So having gone over all these, let's have a look at how they compare. And I have the results on the screen. So what I've done, I've tested each of these 10 different mean reversion entry setups on the SPY on daily data, starting from year 2000 up to now. Please bear in mind that we are only testing the edge or the validity of the entry setup. We are not developing an actual strategy as such. When I develop my actual strategies, I don't obviously test the strategy on all data that I have available, because that can result in what's called curve fitting. However, in this particular case, I'm only looking at the validity of the setups on SPY itself. We really just trying to get a rough idea about different mean reversion entry setup. So I've got all 10 results on the screen. This comes from AmiBroker, which is a software of my choice that I use. And actually, if you are my subscriber in my flagship program called 5-Week Portfolio, if you have access to my Discord community, I will share this code with you there. We can see various information on the screen, but the only thing I'm really interested is the risk-adjusted return. I'm not actually looking at the actual return, which is here, because it's really irrelevant. This is not a final strategy. All I'm trying to do at this stage is I'm trying to determine whether a given mean reversion setup has got some merit to it, and if it's worth pursuing further. And we can see that the highest is number 7, which if I just refer back to my code, was that the market closes 1% below its previous day close, and the volatility environment is classified as decreased volatility. Number 2 is the cumulative RSI reading. So that's very interesting because it's actually ranking higher than number 1, which was the one-day RSI. And we can actually see that this particular cumulative RSI reading setup has got the lowest drawdown as well. And then if I just go to the bottom, number 4 was that the market closes lower 3 days in a row. So this kind of analysis can truly give you lots of insight that you can then use later when developing your own strategy. So this is what I do normally when I develop my own systems. In this case, what I'm going to do something with the cumulative RSI because I like that idea the most, and also the number 7 because it ranked the highest. So in some of my next videos, I'm going to take this a little bit further and show you some basics of how to start developing your mean reversion strategy. So hope you enjoyed this video and took some valuable insight for your own trading. Thanks very much for watching. David at Critical Trading, signing out.